In this video, we'll be analyzing one of the largest railroad companies in the country that has raised their dividend over 13% on average over the last 5 years. This is episode 3 of my subscriber suggested stock analysis series, and today, like I said, we'll be analyzing the aforementioned railroad company, which is Union Pacific, ticker symbol UNP. As most of you probably know, Union Pacific is one of the nation's largest railroad companies. It connects 23 states in the western two-thirds of the country and also connects with Canada's and Mexico's rail systems. The company operates over 32,500 miles of railroads, and they generate their revenue from 3 main commodity groups. So the first of these groups is called bulk, which accounts for about 33% of the company's revenue. And the bulk group consists of grain, fertilizer, food, coal, and renewables products. Some of those renewables products actually are biomass products and also lots of wind turbine components. The next group is industrial, which accounts for about 35% of revenues, and this group primarily transports construction materials, chemicals, plastics, forest products, metals and ores, petroleum, soda ash, and sand. And this group sees a lot of shipments of infrastructure related materials at the commercial, residential, and governmental levels. The final group here is called premium, and it generates the remaining 32% of Union Pacific's revenues. And premium includes automobiles and automotive parts, as well as merchandise that is shipped in shipping containers. And a lot of that is coming from the West Coast, from overseas, and they help transport some of those shipping containers inward into sort of the middle part of the US more. So now that we know a little bit about the business, let's take a look at some recent operating results, starting with the full year of 2022. In that year, the company generated revenues of $24.9 billion, which was up about 14% year over year, but business volumes were only up about 2%. So a lot of that revenue growth was due to a higher fuel surcharge and other pricing increases. For the year, operating income was $9.9 billion, which was a 6% increase, and net income was $7 billion, which was a 7% increase year over year. The great thing though is that because of their share repurchases, earnings per share was $11.21, which was a 13% increase compared to 2021. So overall, I think it does look like 2022 was a pretty solid year for Union Pacific, despite some of those inflationary pressures that started mounting throughout the year, especially in the case of fuel and other materials. They were able to produce some solid results. And moving on to the second quarter 2023 earnings that they just reported a few days ago, for the quarter, operating revenue was $6 billion, which was down about 5% year over year. And in terms of the actual business volume, that was down about 2% year over year. Operating income for the quarter was $2.2 billion, which was a decline of 12% year over year, and net income was $1.6 billion, which was a decline of 14% year over year. They did make some share repurchases in the quarter, and that reduced their shares outstanding to about 610 million shares, and that helped their EPS decline be a little bit less. So earnings per share for the quarter was $2.57, which was a decrease of only 12% compared to the decrease of 14% in the net income measure. A notable update, as I mentioned at the beginning of the video, is that the company announced a new CEO, which is Jim Vena. Vena had a 40-year career at Canadian National Railway, and he was also the COO or Chief Operating Officer of Union Pacific for a short time in 2019 and 2020. I think investors really liked the news of Vena coming on as CEO. The stock was up 10% today, which was the day of the earnings announcement, despite the fact that their earnings in terms of both revenue and earnings per share numbers fell below analyst expectations. Another notable update as well from this earnings release is that the company announced they're not planning on doing any more share repurchases in 2023, which seems like generally a prudent decision to me. So I think the earnings results were definitely less than ideal for Union Pacific, but I don't think they really spell any major disaster at this point. I think it's definitely expected that they're going to struggle a little bit this year and see a slowdown of some sort, especially given some of the union issues that they're kind of working through and the generally lower fuel prices this year. When we look at the balance sheet, we can see they have about $830 million of cash on hand. They don't actually split out the current assets and current liabilities directly into their own line item total, but we can calculate that ourselves. And for the current assets, we get a total there of $3.8 billion. And then current liabilities, we get a total of $5.2 billion. So current ratio there is definitely less than 1, which is not ideal. That means that they have more current liabilities than current assets, and potentially they could have some trouble paying off those current liabilities within the next year, or they would have to maybe take on some debt to pay those off. So like I said, that's definitely not an ideal situation, but it's also not the end of the world. In terms of debt, they have about $1.7 billion of short-term debt and $31.6 billion of long-term debt, which adds up to a total debt load there of $33.3 billion, which is definitely a lot, I think. Like I always say, the general rule that I look for is for a company's debt to be no more than twice the annual net income of the company. So in the case of Union Pacific, like we saw, net income is around $7 billion annually. So in this case, the debt is more like 4.5 times the net income rather than the 2 times value that we like to see. I think the railroad business is definitely more capital intensive, and that means we can expect Union Pacific to have a bit higher debt. But I think, in my opinion, I think the $33 billion seems a bit high, even given that consideration around their business. And add to that the kind of less than ideal current ratio that we saw earlier. And I think the balance sheet really doesn't look super great for Union Pacific. It could certainly be a lot worse, but I don't think it's stellar by any stretch of the imagination. One good thing for sure is that we can see that shareholders' equity has actually increased pretty significantly in just 6 months since the beginning of 2023 to about $13.2 billion, which, like I said, is a good sign. In terms of dividends, Union Pacific does pay a dividend of about 2.4% right now, and their payout ratio is pretty healthy at 46.5%. But they do say that they are targeting a 45% payout ratio in terms of earnings over the long term, which I think is pretty healthy. It gives them an opportunity to return value to shareholders through that dividend, but it also gives them plenty of room to reinvest back into their business and continue growing their revenue and income over time. Over the past 5 years, as we can see, they have grown the dividend almost 14% on average, which is really awesome to see. And since their payout ratio is pretty much in line with the target payout ratio of 45%, I think that dividend growth will, generally speaking, be sort of correlated with earnings growth, which is generally what you would hope to see from a company and what you would expect to see. But in this case, since the payout ratio is aligned with their target payout ratio, future growth is likely to be very closely correlated with growth in the earnings. And on that note, I don't really think the earnings per share is going to grow in the next few years or decade nearly as much as it has in the past 10 or 15 years. So I think the dividend growth rate is probably going to slow, especially given the kind of tough challenges they're facing this year and maybe moving even into next year. So I think the dividend growth rate is going to slow some, but hopefully it'll still be able to stay in the high single digits to low double digits range. Notably as well, they have been growing the dividend for 16 consecutive years, which is a pretty good streak. I think hopefully it will be the start of a much longer streak in the future. So now at this point in my analysis, I like to start to think about valuation. And the first kind of valuation method I kind of look at is the price to earnings ratio. And right now for UNP, that's about 21. This is a little bit expensive looking compared to their historical average of around 16. But as we can see here, the company has been growing their earnings at a pretty quick rate over that time period. So the compound annual growth rate of their earnings over the past 10 or 13 years has been about 13% per year, which is pretty awesome. But like I said, I don't really think they're going to be able to keep that rate up quite that high. Hopefully they'll still be able to grow their earnings at a nice rate, but maybe not at that 13% rate, at least for the next few years, just because of some of the macroeconomic conditions affecting the business. We can also compare UNP to their peers in regards to the PE ratio, and for the industrial sector that they are a part of, that sector has an average PE of about 18, and the transportation industry as well has an average PE of about 10. So generally speaking, when we take kind of a holistic view of the PE ratio and come up with some sort of valuation qualitatively and quantitatively, I guess, I think UNP does look a little bit overvalued when we talk about that PE ratio, looking just, historically as a company and compared to their peers as well. And the other valuation metric that I like to use is the discounted cash flow model. And when I did this calculation for Union Pacific, I did get a fair value of about $150 per share when using a 7.5% required rate of return, and a fair value of only $80 when using a 10% required rate of return. And to kind of put that in perspective, right now, UNP's current share price is $238 per share, which makes the stock look massively overvalued from the DCF point of view. I don't think, $80 is really a realistic number. I think the fair value is probably a little bit or maybe even significantly higher than that. But I do think that right now the stock is overvalued at this point in time. So in general, I think that Union Pacific is a pretty solid business in terms of the actual value that it provides to customers and society as a whole. Railroads are actually pretty efficient and currently pretty essential to our modern way of life in the US and North America in general. So I think UNP does have some real value there. Their recent performance is, like I said, not exactly stellar, but not really anything to worry about or that is super unexpected. The debt, though, like I said, is on the high side for my liking, but I think it is to some degree expected in the industry that they are in terms of valuation. Like I mentioned, I don't think it's too attractive from that perspective as well. I think, maybe below $200 would be a little bit more interesting, maybe where I would start to be a little bit more interested, but I think probably closer to 150, 175 would be a whole lot more attractive, at least for me. But I don't know a ton about the railroad industry in general and, how they use their debt successfully. So I would want to kind of learn more about that nuance of the business before really committing to a significant investment in UNP. But if you do have any insights to share about the stock or the company or the railroad industry and business in general, I'd love to hear that down in the comments below. Or if you want to join the Discord server, you're always welcome to do that and share your thoughts there with other long-term investors. I definitely appreciate everyone watching the video, and if you haven't subscribed yet, I would encourage and recommend you to do that so you don't miss out on any future investing videos and stock analyses. Thanks again, and I'll see you all in the next one.